Hello, welcome again. So as promised, after having taken the introductory session, now we are going to pick up your first topic. And the first topic which we are picking up is issue of share capital, and without any iota of doubt that you are very well familiar with this particular topic. You have already gone through this particular topic in your earlier phases of education, right from your class 11 to class 12. And perhaps in BCom first year or second year, whatever it might be. So most of the things you are already familiar with the what we call accounting aspects without an iota of doubt, I am very sure. And some of the students consider this particular topic a little bit what we call boring too, but we can't help it, as I just told a moment ago, that we have to be careful, that we have to do each and every facet. So sometimes we feel that we have done this particular topic so many times, so we are very well equipped to handle what we call any sort of problem straight away. But sometimes when we in reality face the problem, we find actually that some of the concepts are missing from our arsenal. So that is the reason I keep on telling you that you have to be a little bit what we call more composed whenever you what we call go through any particular chapter. You have to give it equal importance. So issue of share capital, most of the things actually, to be very honest, are already known to you, as I accept that. But at the same time, we can't help it. We will have to take the topic because it is part of your course. So what we are supposed to take, the aspects when we are going to take issue of share capital, correct? So issue of share capital, this is the topic we are taking now. We'll talk about in this particular session a little bit about theoretical aspects, and then in the next session we'll take up the accounting aspects. So a little bit of preservation, a little bit of perseverance, and a little bit of endurance we need to show whenever we are doing a particular chapter. So we will try to recap the things. We will try to recap not only the things, but we will try to add some spice to it also, so that you feel ease with this particular topic. Now, issue of share capital. First of all, let me write issue of share capital. Should I write in full form? Well, issue of share capital. Of course, we are doing this particular chapter in the light of what we call Companies Act 2013 now. Companies Act 2013. The rules which are applicable to Companies Act 2013. On the basis of that, this particular chapter is being done over here. Now, what we are supposed to study under this particular chapter, because most of the things I accept that you are already familiar up with. Now, sometimes it becomes a little bit complicated for the teachers also when he teaches something and a student is already aware of that. So it becomes all the more a great challenge in that particular case to keep the interest of the student very live and lively. So how we shall achieve that, we'll try to find out. But first of all, we'll try to talk a little bit of what we call theoretical aspect, and then we'll move over to practical part. Lots of questions are there, almost 31 questions in this particular chapter. Now, as far as company is concerned, but first of all, let me tell you how we have to move about, correct? So, in this particular chapter, as I just told you, first of all, we'll take into account the theoretical aspects in this particular session especially. So we'll talk about theoretical aspects. In this particular chapter, we will talk about theoretical aspects, and I've seen that sometimes students actually tend to ignore these things. For example, suppose if I would ask you a very simple question. You have heard the word company lots of time, correct? Haven't you heard about it or not? So we have heard about it at least on 1000 occasions. Yeah. So you have heard about this particular word so many times, but still I would love you to tell me. Could you tell me from which word company has been derived? So these are the things I want to, because being a professional student, you should be aware of everything. You know the accounting treatment, you know the entries, you know how to solve the problems. But in spite of that, as I told you, it's a pretty challenge for me to keep your interest on a very high. So for the same, I will have to tell you some in-depth points. So company, could you tell me actually, as I told you, where this particular word we derived from? Yes, some of the student I can hear, they know, yes, it has been derived from Latin word. That Latin, Latin, it has been derived from Latin word, that is com, com, and com means with, correct? So word company, it has been derived from Latin word. It has been derived from Latin word, that is com. This com is a Latin word. This is a Latin word, correct? Now, what we mean by com? Com means to be togetherness. You can simply say it, correct? Com actually means with or togetherness. So, com means togetherness or with. Now, company. Because you are a professional student, you need to dig very hard. You should not believe in superficial study. Now, what we mean by P-A-N-Y, actually this word, company, is combination of two words. Two Latin words. One is cum and another one is panis. P-A-N-I-S. And it is also a Latin word. So company is, as I told you, is a combination of these two words, and panis basically means bread. And com means togetherness. So now you know the meaning of company, and you also know the origin of the word company. So company, as you can see, because it refers to togetherness and why people have gathered to earn the bread, correct? So that is the reason you keep on telling that company is nothing but it is an association of persons. It can be said, isn't it or not? It is an association of persons, like-minded people. They associate themselves to carry out some business activity, isn't it or not? But the point is that you also know that company is a corporate body. We keep on telling that company is an artificial person, company is a corporate body. It has got a distinct entity from its members. Now the point is that company is a corporate body. What does this word corporate stands for? See here. That is the reason actually I keep on telling to the student that they should be aware of all these things, because you are a professional student, and tomorrow if you are going to give some interviews in the leading entities, then they are going to ask you such questions. So at that time, you should not cut a sorry figure before them, because you know the art of accounting, but at the same time you should be aware of all these things. Then only you will be called a true professional. So corporate, it has been derived from, again, Latin word corpus. And this word corpus basically means body. Is it clear to you? So in this particular session, as I told you, that we'll talk about a little bit theoretical aspect, just to keep your interest a little bit high and live. So now we understand the meaning of company, that company basically is nothing but company is an association of person. It is a corporate body. It is a corporate body. It is an artificial person, correct? It has been created by law. It has got a different entity. When we say it is an artificial person, when we say it has been created by law, it has got separate entity from its members. It also means that a company can be sued and company can sue somebody also. Is it clear to you? So these are the things which you should be aware of regarding at least word company. So you know the meaning of company, you know the definition of company. I am not falling over to that particular part. You also know the characteristic of the company. Now could you tell me what are the characteristics of the company? So one, it is an artificial person. Well, I have accepted. It has got separate entity. Yes, you are absolutely right. It has got perpetual succession. Perpetual succession means the life of the company is never ending. The members may come, members may go, but the company will go forever. And the shares of the company are easily transferable. However, some restrictions have been imposed upon the private company. They cannot easily transfer the shares. Isn't it or not? So, now you should know a little bit about the statutory books also. You know the accounting part, I know very well, but at the same time little bit of theoretical part, because from this particular chapter, to be very honest with you, lots of theoretical questions are being tossed up in the examination. So, what are statutory books? What do you mean by that? All these answers have been written in your notes, which have been supplied by us, but at the same time, you should also little bit be aware of all these things. Statutory books, what do you mean by statutory? Statutory simply means something which is enforced by the law. Are you getting my point or not? When law of the land enforces something, that is known as statutory. So Companies Act 2013 is very, very specific and very, very clear that an entity will have to keep some books, statutory books. I will tell you about those books, but some books which it must maintain because of the guidance of the law. So that is the reason actually why these books are known as statutory books. Correct? As I told you, the Companies Act 2013 has laid down very specifically that every company incorporated under the law must maintain and keep at its registered office certain books and registers. Correct? For example, a company must keep register of securities. Statutory books. I am not writing, it is written in your notes also, but at the same time you should be very well aware of. One, a register of securities company must keep. Is it clear to you? Then register of securities bought back, then register of deposits, then register of charges, then register of members. Then similarly, company must maintain register of debenture holders, then index of debenture holders, then register of foreign members, then besides that register of annual returns. So all these are considered as statutory books. Now suppose question strikes that name any 3 statutory books. Could you tell me, name at least 3 statutory books? One, register of securities bought back. Second, register of deposit. Third, register of charges. Somebody told me down over here. Fourth, index of the members. Right. Similarly, register of debentures. Then index of the debenture holders. Then similarly, register of annual charges. So there are so many statutory books. Register of foreign members. So at least 5 you should be aware of. Is it clear to you? So why I'm talking about? Because in our earlier phase of education, we tend to skip all these things, and this is the level, things which we have skipped in our earlier phase of education, we should do that also. So that is the reason why I brought about this particular topic, statutory books. So statutory books are the books which the law of the lands actually wants an entity to keep at its registered office. Correct? So at least name of 5 statutory books should be memorized by you, or should I say should be known to you. Is it clear to you? Then besides that, we'll talk about books of accounts. Books of accounts. There is a difference between statutory books and books of accounts. Books of accounts. After all, you are doing the accounting, isn't it or not? You are doing the accounting, and the chapter also deals with issue of share capital. Of course, here we are more concerned with the accounting for issue of share capital. But in spite of that, you need to know a little bit about books of accounts. Section 128 of Companies Act 2013 deals with it. Section 128. So what we mean by books of account? Now, maintenance of books of account would mean records maintained by the company to record the specified financial transaction. That is what the law states. But what we mean by the books of accounts, the important thing is that Companies Act 2013 is very, very clear that the books of account must show all the money received and all the money expended. Number one. The books of account must be kept on accrual basis. That is very important. And also books of account must be maintained by following double entry system. Is it clear to you? If something, suppose a question is tossed before you, write a note on books of account. Then first of all you will write that section 128 of Companies Act 2013 deals with maintenance of books of account. So books of account must reflect the total amount of money received by the entity and total amount spent by the entity. Besides, books of account also must reflect the total amount spent on purchase of assets. The books of account also reflect the total amount spent on liabilities. Similarly, total amount is spent on what we call expenditure. So when we say books of accounts, that means a company must maintain its books as per section 128 Companies Act 2013 so as to reflect the total amount of money received. Second, total amount of money spent. Total amount incurred in purchase of assets. Third, total amount spent in incurrence of liability. Fourth, total worth of sales which the company has incurred. Fifth, total amount is spent on purchase of goods. So all these things must be reflected. That is what we mean by books of accounts. So books of accounts, so a little bit of idea you need to have. Then besides that, you also should know, because you are doing after all professional course. So have you an idea regarding the place of books of accounts? Sir, we did not study about it earlier. Place of books. So, where the books should be placed, where the books should be maintained, correct? Section 128 subsection 1 of Companies Act 2013 deals with it. Section 128 subsection 1 deals with it. Is it clear to you? So as far as place is concerned, the section 128 subsection 1 is very clear. It requires every company to prepare and keep the books of account and other relevant books and papers and financial statements at its registered office. Is it clear to you or not? If somebody asks you where the books of the company should be placed, so it should be placed at the registered office. However, in some special circumstances, a company can maintain and prepare and place its books at its branches also, at the discretion of the director. That's a different matter, but generally books of accounts should be maintained and placed, as I said earlier, at the registered office of the entity. So these are the things which you need to know a little bit about. Then we come over to share capital. Correct? These are the things which you should know being professional student. Share capital, you know better than I that share capital of a company is of following types. I'm not going to dwell much about it because most of the things you are already aware of. As far as share capital is concerned, you know, one is nominal capital. It is also known as authorized share capital or registered capital. Nominal capital, registered capital or authorized capital. Registered capital or authorized capital. Correct? Now this is the maximum capital which an entity, whenever I would say entity, you immediately infer it that I am referring to a corporate enterprise, correct? So nominal registered authorized share capital, as you know, this is the capital with which an entity gets itself registered. It is the maximum capital which an entity can raise from the public during its lifetime. But have you given, during one interview, to be very honest with you, I'm also associated with some companies, so sometimes I'm called, especially when their interview sessions are on. So I have seen that this particular question has been tossed before the student, that what you mean by nominal capital. So students simply answer that actually, sir, it is the maximum capital. Of course, it is the maximum capital. It is known as registered capital. We come to the reason because companies registered with this capital. It is known as authorized share capital because law has given an authorization to the entity to raise this much of capital from the public. But why it is also known as nominal capital? Nominal means something which exists just for namesake, not in reality. That is what we mean by nominal. And why it is known as nominal capital? Because this capital, to be very honest with you, exists only for namesake. In practical life, no company raises or issues the maximum capital which has been authorized. So what I mean to say is that this capital exists just for namesake, because never ever an entity will raise the full amount by which it is registered. That is the reason it is called as nominal capital. So these are the points which I would love you to know. Being a professional student, we should not do superficial study, as I keep on telling. We need to do in-depth study, insightful work. So this is nominal capital. Then B, as you know, that is issued capital. I need not require to tell you what we mean by issued capital. So that part of capital which is offered to the public for subscription, that is known as issued capital. You know already all these things. Then there is called up capital, and called up capital means that part of issued capital which is called up, correct? And then there is paid up capital also. So paid up capital means how much amount actually has been received by the entity, because there might be some defaulters. For example, if you have called up, let us say 5 lakh, but you have received only 4 lakh 80,000, then it is your paid up capital, and your called up capital is 5 lakh and 20,000. It's called scenario. Then we have got registered capital. Sorry, reserve capital. I'm extremely sorry. Registered, we have already written. Reserve capital, part of share capital, is always kept as a reserve. Now that depends upon the what we call discretion of the director. It is the prerogative, it is the discretion, it is the choice, it is the prerogative of the director that they can set aside a part of their total authorized capital as a reserve capital. Now reserve capital means this capital cannot be raised from the public. This part will be utilized only at the time of winding up. Correct? So that is the reason that sometime entity or sometime director, should I say, that keep a part of their capital as reserve capital, and that part is not issued to the public. This part of capital or this capital, reserve capital, is meant to meet contingencies, especially like winding up. Correct? Then, after having done this, you need to know a little bit about the application for shares. Application for shares. Sir, we know a lot about that. Yes, you know. Application. You are very intelligent people. I know about that. Not for a moment. I'm telling you that you do not know anything about that. You know perhaps a little bit more than I, but still my duty is to cover each and every facet. I will ask you a very simple question. Which section of Companies Act 2013 deals with application? Now section 39, some of the student told me, that's great. So section 39, subsection 2, Companies Act 2013, of course, now covers application of shares. Correct? What you know about that? Of course, whenever shares are issued to the public in practical life, all these things should be known to you. So whenever shares are offered to the public, of course, for subscription, it is the duty of the entity, it is the duty of the company to give some information, correct? An extract of the prospectus. An extract. Extract means piece, not the complete prospectus. So company will give some extract of information regarding itself. So whenever a company wish to actually raise capital from the public through issuance of the shares, then company will have to, of course, give some information, or should I say an extract of prospectus regarding the performance of the company, regarding the profitability or potentiality of the company. Now, if you people, that means those who are interested in buying the shares of the company, if you people find that performance or the profitability or the potentiality of the entity is up to your expectation, definitely you would love to buy the shares of the company. In that case, you can ask the entity to give the complete detailed information or detailed prospectus to you. And it will help you in making up your mind whether you want to invest in this particular company or not. So that is how in practical life the applications are received. Is it clear to you? Now, the main point which I want to tell you is that Companies Act 2013 is very, very clear that application money should be at least 5%. Application money should at least be 5% of the face value. At least 5%. This is Companies Act, correct? Suppose a company is offering a share of the face value of rupees 100. Could you tell me what will be the minimum amount of application? Yes, minimum amount will be at least 5, that is 5%. Is it clear to you? That means application money cannot be 4, but it can be 6, it can be 70, it can be 80, and it can be 100. Isn't it or not? So at least 5. But just for your knowledge sake, that this is the guideline of Companies Act 2013. However, as far as SEBI guidelines are concerned, SEBI, that is Security Exchange Board of India, SEBI guideline is that application money should be at least 25%, at least 25% as per Security Exchange Board of India, correct? So unless and until question specifically states SEBI, we shall always follow Companies Act 2013. Is it clear to you? So don't ask this question, sir, when we have to follow SEBI, when we have to follow Companies Act. It is just for your knowledge sake, and all we have to do, we have to apply the provisions of the Companies Act 2013 unless question asks specifically us to follow SEBI guidelines. Is it clear to you? Then we come over to the allotment. So you have known a little bit about application. Now I would love you to know a little bit about allotment. Now when applications will be received, of course, then after receiving the applications, directors are going to allotment of shares. First of all, let me write allotment of shares. Allotment of shares. So once the applications have been received, the next part is that directors are going to, of course, assess the applications of the applicants, and if they find that all these applications are conforming to the requirement, then applications will be accepted. However, it is complete prerogative. Prerogative means right. It is complete prerogative that director may accept, director may reject, they may partially accept, they may partially reject. So these decisions are complete prerogative, complete right of the directors. It is up to the directors whether they want to reject, whether they want to accept. So shareholders, or should I say applicants, they cannot question the decision of the directors. It is important to understand, what do you know about the allotment? Main thing is that Companies Act 2013 is very clear with respect to the allotment. It is given in your notes. I would love you to pay attention because this question has been tossed up so many times, especially third paragraph. You must understand that no allotment can be done unless and until minimum subscription limit has been satisfied. Is it clear to you? And prospectus or a statement in lieu of prospectus has been what we call filed with the registrar of the company, and similarly the amount of application is at least 5% or higher of the face value. So what you need to know about the allotment of share is that, number one, an entity cannot allot shares unless minimum subscription has been received. Second point is that a copy of prospectus or a statement in lieu of prospectus has been filed with the registrar of the company, and application money is at least 5% of the face value or more than that. Then only you can allot the share, and the shareholder to whom shares are allotted will be sent letter of acceptance, isn't it? And those whose applications are rejected, they will be sent letter of regret. Is it clear to you? So applicants whose shares are accepted will be sent letter of acceptance or letter of allotment, we call it, and those whose shares are rejected will be sent letters of regret. So this is the process of allotment of shares. So these are the things actually I wanted you to know a little bit about, because we tend to skip all these things. Then you need to know a little bit about call money. What you know about call money, you should be very, very honest. I just told you a moment ago that when you pursue a professional course, you should not lie to yourself. You should be very honest. Because I know that most of you guys are quite unaware regarding calls. I just told you that application money should be at least 5%, but it can be higher than that. Obviously, then some amount will be called up at the time of allotment. Now, after that, the calls will be made. Do you know the process of calls? The important facet of the calls is that, one, at least a period of 1 month must elapse before another call is made. Suppose if today you have made the allotment, the next call can be made after 1 month, and next call, subsequent call can be made after 1 month. So regarding calls, what you should know? One, at least 1 month must elapse between two calls. This is the one. Second point is that, do you know anything about the call money? Yes, again there is a restriction. That is the important point. The amount of calls should not exceed 25% of the nominal value. Should not exceed 25% of the nominal value. For example, if the share is of 100, then maximum amount of call can be 25. It cannot be 26. It can be 24, but it cannot be 26. So these are the things. And second and third important point is that a 14 days notice must be given to the shareholder to pay the amount. Is it clear to you? So three important facets regarding calls. What? 1 month duration must have elapsed before another call is made. Second important point, 14 days notice must be given to the shareholder to pay the call money. Third important facet is that call money cannot exceed 25% of the face value. Is it clear to you or not? So if it is clear to you, then nothing better than that. We will talk about them a little bit also regarding issue of shares at a premium. As you know that shares can be issued at premium also. Of course, when we will take up accounting part, we will talk a lot about all these things. Issue of shares at a premium. Section 55 of Companies Act 2013 deals with this. Suppose if I ask you to give me some facets of issue of shares at a premium, then what you will let me know of? I'm very sure that you will tell me, sir, issue of shares at a premium is when issue price of the share exceeds the face value. Very good. That is exactly what we mean by issue of shares at a premium. So if share of 100 is issued in the market at 150, then it is a case of issue of shares at a premium. Security premium is a gain to the company and it is reflected under the reserve and surplus heading when we will prepare the balance sheet. Correct? Amount of security premium can be utilized A. for writing of preliminary expenses, B. for writing of discount on issue of shares, C. for writing of premium on redemption, D. it can be used for the purpose of bonus issue. Is it clear to you or not? So you should know all these things regarding issue of shares, because lots of time theoretical question has been asked to write a note on issue of shares at a premium. Correct? So what will you tell me? So issue of shares at a premium means issuance of share at a value higher than the face value. Security premium is a gain to the company and it is reflected under the head reserve and surplus as far as balance sheet is concerned. Then security premium amount received by the company can be utilized A. for writing off preliminary expenses, B. for writing off discount on issue of shares, for writing off miscellaneous expenditure, for writing off premium on redemption, and security premium can also be used for the purpose of bonus issue. Of course, when we'll pick up the topic of bonus issue later on, then at that time we will again retake all these points. Then you should know a little bit about issue of shares at a discount. Most important point now. Issue of shares at a discount. Section 53 of Companies Act 2013 deals with it. Very important point, just pay attention, I have put up a cross. Sir, why? The reason is that Companies Act 2013 Section 53 states that an entity now cannot issue shares to the public at a discount. But at the same time, you can issue shares to the vendor at a discount, and even when you are reissuing the share, at that time you can give discount. Is it clear to you? So it means the questions on discount have become irrelevant. Correct? If any discount has been offered by the entity at the time of public issue, now it is not possible according to Section 53. So that is why such questions have become irrelevant. But at the same time, you should not derive any confusion that a shares can be issued at a discount to the vendors, and at the same time, when after the forfeiture of share, when we reissue them, generally we give some discount. So at that time we can give the discount. Section 53 never prohibits it. Is it clear to you? Now then we will pick up also issue of shares for consideration other than cash. Issue of shares. Issue of shares for consideration other than cash. Issue of shares for a consideration. Issue of shares for a consideration other than cash. For a consideration other than cash. What does it mean? When we issue shares to the public, we means the company. What we receive against the same? Of course, we receive cash. Often what happens, our company purchase assets or what we call other things. From those whom we purchase are known as vendor. The suppliers are known as vendors. Correct? If I am purchasing a building from Mr. A, then Mr. A is vendor. I am the purchaser. So now I am a company. I can settle the amount of the consideration. Consideration means the price. I have purchased the building, say, for rupees 10 lakh. But I thought it is better, rather than paying cash, I should issue them shares. So often an entity, what it does, it settles the price or purchase consideration by issuing shares. So in that case, company is not receiving cash, company is receiving some other asset. Isn't it or not? So that is what we mean by issue of shares for a consideration other than cash. So we'll do lots of questions when we'll pick up the what we call practical part of this. So these are the things, and besides that, you should know a little bit about calls in arrear and calls in advance. Calls in arrear. Calls in arrear. Now, calls in arrear simply means sometime company has called up the amount but shareholder has failed to pay the same. So such calls are nothing but calls in arrear. Correct? So sometimes shareholders, they do not pay the called amount which has been called. So in that case, their amount is still in arrear. So from such shareholder, an entity can charge some interest, that is known as interest on calls in arrear. So what exactly, as per Companies Act 2013, is the rate of interest on calls in arrear? You should be aware of this. So interest on calls in arrear now is at the rate of 10% as per table F. Correct? Earlier means as per Companies Act 1956. Earlier it was governed by table A, but now it is governed by table F. Correct? So table F states that interest on calls in arrear will be levied maximum at the rate of 10%, but at the same time, it doesn't mean that every time you have to actually impose at the rate of 10%. Suppose director decide that they are going to charge interest 7%, then fine, but at the same time, directors cannot charge 11%. The important point is this. This is the maximum interest which the entity can charge from the shareholder. Similarly, as you know, sometimes shareholder, they pay amount in advance. Correct? For example, final call is paid along the first call, or first call is paid along the allotment. So in that case, company has received some advance from the shareholder. So company obviously will have to give some interest to such shareholders. Now, what exactly is the rate of interest on calls in advance? Calls in advance. So rate of interest on calls in advance as per Companies Act 2013 is now 12% per annum. Correct? It is 10% per annum, but these are maximum rate of interest, and at the discretion, at the choice, or at the prerogativeness of the directors, these interest rate can be little bit lower than 10% or 12% respectively. Is it clear to you or not? So these are the facets which we will cover. And last point is that we will also cover when shares are issued to promoters. What exactly we mean by issuance of shares to promoters? Correct? So when we issue shares to the promoters, what will be the case? Suppose Mr. A, B, C, D, E, F, G. Correct? These people have taken the initiative to launch a company. Because company is a separate person, this company now can issue shares to Mr. A, Mr. B, or Mr. C. It can also issue shares to the general public, and it can also issue shares to those persons who have taken the initiative to start the company. To be very honest with you, these 7 guys, or those guys who take the initiative to launch and establish the company, are basically termed as promoters. So in simple words, issuance of shares to persons who have promoted the company or who have taken the initiative to promote or launch the company is known as issuance of shares to the promoters. All these points which we have covered in this session will be covered later on when we will do the accounting area. Correct? From the next session we will cover the accounting part. This is just the bird's eye view that what we are supposed to do in this particular chapter. So when shares are issued to the promoters, that is known as issuance of share, and now you know the meaning of promoters. So when we issue the shares to the promoters, our entry will be goodwill account debit to promoters account, to share capital account. Goodwill account debit to share capital account, correct? Now you might be wondering, sir, why we are writing goodwill here. Remember one thing, you are not receiving anything. Number two, you are writing goodwill because it is a loss to the company, and we will see that goodwill is used especially in the context of company as capital loss or as capital profit. We will talk about these points, as I've already told you, when we will cover all these topics later on. So these are the things which we are going to cover. So I'm very sure that most of the things are known to you, but still I believe that I have done a little bit of effort to keep your interest very much alive. So with such hopes and aspiration, as always, we from here in Delhi now take leave of you. Thank you very much for your company, and it's a lovely, lovely good night from here.